Hello everyone, my name is Chris and I'm a mortgage broker, and I've been getting a lot of questions about the DSCR loan. To be honest, it's one of my favorite loans as it's the loan I personally use the most frequently for my investment properties, as I do not qualify for conventional financing anymore. So what do the letters DSCR stand for? Well, debt service coverage ratio. So what does that mean? Well, basically it means that the lender wants the asset to service the debt, the mortgage, through the expected long-term rent on the property. And well, who exactly uses those loans? Well, me, for example. Typically, it's going to be individuals that can no longer qualify for conventional loans due to one of two reasons. Number one is usually due to debt to income, meaning that their taxable income is not enough to cover, the requirements for a conventional loan. Another reason would be if you have more than 10 financed properties. Once you have more than 10 financed properties, it's extremely hard, if not impossible, to get another conventional loan. DSCRs are only allowed for investment properties, and they cannot be used to buy a primary or secondary residence. Now, why would you use this DSCR loan over a conventional? Well, you wouldn't. And the reason for that is conventional loans will typically have better rates and terms than their DSCR counterparts. So why would you use the DSCR loan? Well, the reason you'd use it is because this does not look at your personal debt to income, and it is not used to qualify for the loan. This means the lender should not be asking you for any tax returns, W-2, student loan payments, or pay stubs. So we don't care about any of that stuff. So if we're not looking at your income or your debt to income, the next big question people ask is, how do I even qualify for this loan? Well, they're going to qualify you on primarily three things. Number one, they're going to look at your credit score, and that's how your rate is based off of. The higher the credit score, the better the rate's going to be. They're also going to check your credit report to make sure that you're paying all of your mortgages on time. The next thing that they're going to look at is your bank statements. Like they would for any other loan, they're going to ask for typically the last 2 months, determine that you have enough funds for the down payment, the closing costs, and reserves. The third thing that they're going to look at is the property itself through two appraisals. They're going to do what is called a 1004 and a 1007 appraisal. The 1004 determines the value of the home, while the 1007 determines the estimated value of rent that you should be expected to receive on that property. So how do we go about calculating your DSCR ratio, which is the most important piece of a DSCR loan? Well, we take your expected rental income from the property divided by the mortgage payment, or its PITI, principal, interest, taxes, and insurance, as well as any other HOA dues that may be applicable to your scenario. Most of the time, lenders are looking for what is called a 1-to-1 ratio. This means that the expected rent from the property is as much or greater than the expected mortgage on the property. But to be honest, it really depends on the lender, because I have lenders that will do no ratio loans. They'll go down to 0.75. I have some that require 1.25. So it really just depends on the individual lender, as there are so many out there that will do this. So where does the expected rent number come from? Well, it's going to come from what is called a 1007 appraisal. A 1007 appraisal is a rent comparable schedule that the appraiser will do at the same time that they do the 1004 appraisal, which is how you determine what the property is worth. Most lenders will not look at any short-term rental data, as to be honest, they're really looking for their worst case scenario, which would be Airbnb maybe doesn't work and you have to rent it out to a long-term tenant. Lenders are risk averse, and so the majority of them only look at that number. So now let's run an example of how to calculate a DSCR ratio. The way you do that is you take the expected rent on the property divided by the mortgage. So let's say, for example, you have an expected rent on a property of $2,000 and the expected mortgage on that property is $1,900. So you take $2,000 divided by $1,900. What you're going to end up with is 1.05. That means that your DSCR ratio is above 1-to-1, and most lenders are more than happy to take that loan. So now let's flip it around the other way. Now let's say that your expected rent on the property is $1,900 and the expected mortgage on the property is $2,000. Well, when you do that math, you're going to get 0.95. This means that your rent does not cover your mortgage payment. It only covers 95%. Most lenders will allow you to go down to 0.75, but honestly, it really just depends. Another reason investors choose to close homes with DSCR loans is because most lenders will allow them to close the title in an LLC, so the ownership of the home. Now, the loan is still going to be under your personal name in 90% of scenarios, but the title/ownership of the house can be put in an LLC. Now, even though these loans are easier to qualify for, there are some downsides to these loans. Like I said before, sometimes the interest rate can be a little bit higher than conventional loans. Sometimes they can cost a little bit more to close in the terms of points and lender costs. And the third thing would be prepayment penalties. Now, as a borrower, you get to choose the length of the prepayment penalty. Typically, there are options for a 5-year, 4-year, 3, 2, and 1. So what does this mean? If you pick a 5-year, that means that for the first 5 years, if you were to pay off that loan for any reason, that you would be hit with a prepayment penalty. Now, there are a few forms of this, and it is very lender specific. So, for example, one of my lenders has a 5% flat fee for the length of the prepayment term. Whether it's 1, 2, 3, or 4 or 5 years, it is 5% flat. So if you have a $100K loan and you pay off that loan before 5 years, 60 regular payments, they're going to hit you with a $5,000 prepayment penalty. After 60 months, it will fall off. So another example of a way that they structure prepayment penalties are what's called a step down. So literally imagine a staircase. The first year is where it's the highest. So if it's a 5-year prepayment penalty, it's a 5% fee if you paid off in the first 12 months, 4% in month 13 to 24, 3% for month 25 to 36, and 2% for month 37 to 48, and then 1% the final year, month 48 to 60, and after 61 months, it will completely fall off and you would not be penalized. The reason you would take a longer prepayment penalty over a shorter one, which would obviously be more favorable, is because they give more favorable rates to the longer prepayment penalty terms. Me, for example, I'm a long-term investor in my real estate, so I will typically get a 5-year prepay because for the most part, I'm not looking to do anything with my property for the first 5 years that I own it. Recently, more and more investors have been looking at using this program primarily because of the debt-to-income issue. One of the most common people that come to me are Airbnb investors because once they get an Airbnb, they have to hold that property for typically 2 years before Fannie Mae or Freddie Mac, the conventional lenders, will count that towards their income. So they have a house that maybe has a $2,000 a month mortgage and maybe they're killing it on Airbnb and bringing in $4,000 a month. Well, it doesn't matter because Fannie Mae cannot use that until it's on your taxes, your Schedule E typically, for 2 years. So you have a mortgage payment that cannot be backed up with any income. And so it usually throws their DTI out of whack and they have no choice but to start using loans like this. So now that you guys understand what the DSCR loan is and how it works and that it's only for investors, the other thing I've been seeing other investors do lately is called the BRRRR method. I've actually used this myself personally several times. The reason I've used this method is because I've seen investors go from 1 house to 10 houses in a very short period of time. I've made a video for you guys about this method right here.